Hello, my name is Gillian. This is the fourth week life skill project for the Intermediate Accounting 2 class. The company that I chose was Apple Inc. and in this chapter we are going to discuss everything related with the debt securities. Apple Inc. categorizes its marketable debt securities as either short-term or long-term based on each instrument fundamental prescribed maturity date. Marketable debt securities with maturity of 12 months or less are classified as short, and marketable debt securities with maturities greater than 12 months are classified as long-term. Marketable equity securities, including mutual funds, are classified as either short-term or long-term based on the nature of each security and its availability for use in current operations. The company marketable debt and equity securities are carried at fair value with unrealized gains or loss, net of taxes, reported as a component of accumulate other comprehensive income in shareholders' equity, with the exemption of unrealized losses believed to be other than temporary which are reported in earnings in the current period. The cost of securities sold is based upon the specific identification method. In accordance with the fair value accounting requirements, companies may choose to measure the eligible financial instrument and certain other items at a fair value. Apple Inc. has not chosen the fair value option for any financial instruments. All high liquid investments with maturity of 3 or less at the date of the purchase are classified as cash equivalents. Apple marketable debt and equity securities have been classified and accounted for as available for sale. Management determined the appropriate classification of its investments at the time of purchase and re-evaluate the classification at each balance sheet date. The company's investment in available for sale securities are reported at fair value. Unrealized gains and losses related to changes in the fair value of securities are recognized in accumulate other comprehensive income net of tax in the company consolidated balance sheets. Changes in the fair value of available for sale securities impact the company net income only when such securities are sold or an other than temporary impairment is recognized. Realized gains and losses on the sale of security are determined by specified identification of each security cost basis. The company regularly reviews its investment portfolio to determine if any security is other than temporarily impaired, which will require the apples to record an impairment charge in the period any such determination is made. In making this determination, the company evaluates, among other things, the duration and extent to which the fair value of a security is less than its cost, the financial condition of the issuer and any change thereto, and the company's intent to sell, or whether it will more likely than not be required to sell the security before recovery of its amortized cost basis. The company assessment of whether a security is other than temporarily impaired could change in the future due to new developments or change in assumptions related to any particular security, which will have an adverse impact on the company's operating results. Company determined that impairment has occurred. It records a write-down equal to the amount by which the carry-in value of the assets exceeds its fair value. Other income and expense will vary materially from expectation depending on gain or loss realized on the sale or exchange of financial instrument. Impairment charge resulting from revaluation of debt and equity securities and other investment change in interest rate, increase or decrease in cash balances, volatility in foreign exchange rate and change in fair value of derivative instrument. Increased volatility in the financial market and overall economic uncertainty will increase the risks of the actual amount realized in the future of the company's financial instruments, differing significantly from the fair value currently assigned to them. The company also reviewed its manufacturing-related capital assets and inventory prepayment for impairment whenever events or circumstances indicate the carrying amount of such assets may not be recoverable. If the company determines that an asset is not recoverable, it records an impairment loss equal to the amount by which the carrying value of such as an exceeds its fair value.